Hi, this is Brett Sankis with Sankis Law and Brayton Woods, and this is Misconception Monday. Today we're debunking the myth that venture capitalists are in the business of taking risks. That is not true. Venture capitalists are in the business of mitigating risk relative to reward. So Brett, what the heck does that mean? That means that venture capitalists are very circumspect about the risks they take on. They're much less risk preferring than most people think. Now, they are looking, at the early stages, so in a seed stage, Series A, they're looking for big returns, 10 times return on their investment, because 7 out of 10 of their investments will fail. So they accept risk, but they're very careful about their risk. They're very careful about what the reward is. And so compared to entrepreneurs who start a business and go and fail at spectacular rates, regardless of whether or not they're shooting for the moon or they're trying to build a lifestyle business, whatever it is. I mean, businesses in this country fail at a very, very high rates. And entrepreneurs take huge risks, put it all on the line. They have no safety net. It's their money, it's their time. Venture capitalists get involved considerably later in the game. They get involved at the seed stage, and some don't get involved until the Series A stage. So seed doesn't mean the first money into a company. The first money into a company is the founder money, and then friends and family money. Seed stage means, the company's got a little bit of traction. Usually doesn't have any revenue yet, but it's getting somewhere. It knows what it wants to be. Sometimes it has some revenue, but seed rounds are, in Silicon Valley, a few $1 million. So this isn't, real early. That's when the venture capitalists step in. Okay, so the team's generally been formed to a large degree. What the company wants to accomplish has been, they've done some research, there's been some de-risking. It's still a risky stage. Series A, which follows seed stage, is considerably less risky. The startup has been now isn't a startup, it's just a business. It's been de-risked even more. The company has some degree of product market fit. It has almost always some revenue. That's where a lot of venture capital money comes in. So the entrepreneurs involved way back here, there is nothing but a prayer. And so the venture capitalists step in here. And they still take some risk, but they're very careful about it. And most venture capitalists, the Tier A venture fund, the VC funds out in Silicon Valley, Kleiner Perkins, Sequoia, Benchmark, Andreessen Horowitz, those kind of players, I'd say, you haven't looked at the stats, but I'd be surprised if more than 10, maybe 15% of a fund is invested at that seed stage. I mean, they're very careful about the dollars that go in there. They're trying to pick off really unique opportunities. Second and third time founders, ones who've had successful exits, very game-changing technology, things like that. It's a small piece. And then they're looking to take a position and have a front row seat to put more money in the A round, in the B round, in the C round. And at every round, the business is de-risked more and more of the VC's money comes in. So it's not that they don't take risk, but to say they're in the business of taking risks is usually to fundamentally misconstrue what's going on here. And as an entrepreneur, if your mindset is that's what they do, they take risks, and you haven't been around venture capitalists, you're going to probably butt up against this fact, which is they do take some risk, but they're very careful about it. Very careful about it relative to reward. They don't take a lot of the seed stage bets. And so if they say to you, well, that seems riskier, you haven't thought about that or this, and you might be frustrated, right? Like that's what you do, you take risks. Well, they do, but number one, they can't take every risk, right? So they're being very, very careful about the risks they take. Generally speaking, they're not taking huge risks. You can think about it like this. They're not in the business of rubbing two sticks together to start the fire. And they're really not all that interested in, putting some kindling in there and fanning the flames. I mean, they'll do a little bit of that. What they really want to do is be right there when it's time to pour gasoline on that fire and time to take that business from sort of slight product market fit, maybe $1 million of recurring revenue, to step on the pedal and take that higher. And the risk that they accept is that they're going to just go for it. And some of those businesses won't be ready to go for it, don't have it figured out, they're putting more money in, and they will fail. But they're not taking these risks way down here of, is there even a market? Does anyone even want it? Can the team possibly execute? That's not their business. So that is a misconception. Thanks for stopping by.